Welcome to Richard Suttmeyer's 4 in 4. 4 blips on my radar screen presented in 4 minutes or less. Today is Tech Tuesday, and I will also talk about the Great Credit Crunch. My first blip looks at the daily chart for the NASDAQ and Philadelphia Semiconductor Index, the SOX. The daily chart for the NASDAQ shows an overbought condition in anticipation of a positive market reaction to the FOMC decision on monetary policy to be announced tomorrow afternoon at 2:15. I suggest profit taking given a zone of resistances on the NASDAQ. Daily is 24.58, monthly is 24.96, and quarterly is 25.01. The NASDAQ is below its 200-day simple moving average at 28.28. The risk is to weekly support at 23.63. The daily chart for the SOX also shows an overbought condition and resistance at 395.27. Failure to hold my semi-annual pivot at 390.32 indicates risk to this week's support at 374.13. My quarterly pivot is 372.84. My second blip analyzes the daily charts for Apple and Google, which have renewed mojo status. Apple has become overvalued and overbought, which is quite a shift from being extremely undervalued and oversold at February lows. Apple is trading between my semi-annual and quarterly risky levels at 170.97 and 175.63, and if shares fail in that range, there's risk to the 200-day simple moving average at 152.75. Google is a day away from becoming overbought, but the stock is still 12% undervalued. Google had reached my quarterly pivot at 552.20, but is below the 200-day simple moving average at 565.63. If Google fails in this range, the downside is to my weekly value level at 499.65. Above 565.63 is my quarterly risky level at 588.28. When trading Apple or Google, it's better to buy weakness and sell strength. It's a lot harder to buy high and attempt to sell higher. Quite often, with the latter strategy, you are left holding the bag. My third blip explains why the bulls on community and regional banks are wrong. I have been warning about the risk community and regional banks face for more than 2 years now, and it seems like the problems have been stuck in a third inning rain delay for about a year. We are not through the subprime problems, which I describe as the tip of the iceberg. Morgan Stanley joined my chorus on Monday with similar views. Morgan Stanley told their clients to sell strength in financial stocks, warning that the credit crunch is only just beginning. Analysts for this investment banker expect higher loan losses and related expenses. Back on March 1st, 2007, more than a year ago, I wrote, "I do not believe that the economic drag from housing and real estate markets can end without at least 2 quarters in a row of negative GDP growth." My fourth blip briefly compares my concerns with those of Morgan Stanley. Morgan Stanley cites balance sheet issues, including the need to raise more capital and making deeper cuts to dividends as credit conditions deteriorate and forward earnings decline. Morgan says we're only in the third inning of the credit cycle, which they say will be worse than the slump of 1990-1991. My concerns come from the FDIC quarterly banking profile, including huge exposures to construction and development loans, commercial real estate loans, and home equity loans. The Great Credit Crunch has only just begun. Send your comments and questions to support at rightsideadvisors.com. That's today's 4 in 4. Enjoy your day.